Hi there. In this video, I'll walk you through the 2026-27 dividend tax changes and show you exactly how much more you'll owe.
Hello there, and welcome to this explainer from My Tax Accountant. Today, we're going to get to grips with a huge change that's going to affect pretty much every UK company director and investor, the 2026-27 dividend tax rise. Let's figure out what this really means for your money.
So picture this, right? Your business is doing great, profits are up, but when you look at your own bank account, your take-home pay has actually gone down. It doesn't seem fair, does it? Well, for a lot of UK business owners, this exact situation could become a reality in 2026, all thanks to a few key tax changes. And that's exactly why we're here. At My Tax Accountant, we're all about cutting through the jargon and the complicated stuff to give you straightforward, actionable advice that you can actually use to protect your hard-earned cash.
Okay, here's what we've got lined up for you. We'll start with the tax shakeup itself. Then we'll walk through a real-world example with Chloe to see the impact. We'll get into the salary versus dividend puzzle, give you a strategic playbook, look ahead to what's coming in 2027, and finally, cover your next steps. All right, let's dive right in. Section 1, the tax shakeup. So what is actually changing from April 2026, and how's it going to hit your dividend income? Okay, so here's the headline news. The tax you pay on your dividends is going up by 2%. You can see it right here. The basic rate jumps from 8.75% to 10.75%, and the higher rate goes from 33.75% to 35.75%. Now, if you're an additional rate taxpayer, you can breathe a little easier. Your rate stays the same.
But here's the thing. This rate rise isn't happening in a vacuum. It's being combined with a long-term freeze on all the key tax thresholds, which is a bit of a double whammy. It's often called a stealth tax, and you're about to see why.
Right, these numbers here, they are absolutely key. Your personal allowance stays stuck at £12,570. The point where you start paying higher rate tax is frozen at £50,270, and your tax-free dividend allowance is just a tiny £500. Because these aren't rising with inflation, it means that even a small pay rise can push you into a higher tax bracket completely by stealth.
Okay, theory is one thing, but what does this actually look like in practice? To make this real, let's meet Chloe. She's a freelance digital consultant, and we're going to break down exactly how these changes will affect her bottom line.
So, Chloe runs her business through a limited company. For the 2026/27 tax year, she pays herself a salary of £45,000 and decides to take £10,000 in dividends. That gives her a total income of £55,000. This is a really common setup for directors here in the UK.
Okay, let's crunch the numbers for Chloe. First off, her £45,000 salary eats up all of her tax-free personal allowance and most of her basic rate tax band. Simple enough. Now, for the dividends. The first £500 are tax-free thanks to the dividend allowance. But here's where the sting is. Because of her salary level, only a portion of her remaining dividends gets taxed at that new, lower rate of 10.75%. The rest, nearly half of her dividends, gets tipped over that frozen threshold into the higher rate band where it's taxed at a much chunkier 35.75%.
So what's the bottom line for Chloe? What does this actually cost her? Well, under the old rates, her dividend tax bill was about £2,014. Under the new 2026 rates, it jumps up to £2,204. That's an extra £190 she has to pay in tax for earning the exact same amount of money.
And this thing that's happening to Chloe, it has a name. It's called fiscal drag. It's exactly what this says on screen. As your pay rises, even just to keep up with the cost of living, these frozen tax bands don't move. So you get dragged into higher brackets, and you end up paying more tax even though you're not actually any better off in real terms. Sneaky, right? And if you think that's bad, listen to this. Get this. Back in 2016, the tax-free dividend allowance was a pretty generous £5,000. Today, it's just £500. That is a massive drop, and it really shows you the direction of travel over the last decade. It makes proper tax planning more important than ever.
So, all of this leads us to the million-dollar question for every company director out there. What is the smartest way to pay yourself now? Let's get into the great remuneration puzzle. Salary or dividends?
All right, let's do a quick head-to-head. With a salary, the big win for your company is that it's a tax-deductible expense. But for you personally, you get hit with both income tax and national insurance. Dividends, on the other hand, no national insurance. That is the magic ingredient. But they have to be paid from profits after your company has already paid its corporation tax bill. So, when all the dust settles, which one leaves more money in your pocket? Let's imagine you have £100 of profit to take out. Look at the top row. Taken as a salary, after all the taxes and national insurance, you're left with just £37. Wow! Now look at the dividend row. Even after corporation tax and the new higher dividend tax, you walk away with over £48. It's a no-brainer, really. And the big reason? You've dodged national insurance. That's a huge saving.
So, even though the tax man is trying to close the gap, dividends are still, for now, the more efficient option. Okay, so knowing that, let's build your game plan. It's time to talk solutions. For most of you watching, the best strategy for 2026/27 is going to look something like this. Step 1. Pay yourself a salary, but only up to the national insurance threshold, which is £12,570. That way, it's efficient and it still counts towards your state pension. Step 2, make sure you use that full £500 tax-free dividend allowance. And Step 3, take any other profits you need as dividends. Okay, here's a fantastic tip, especially if you're a higher earner. As soon as your income goes over £100,000, you start losing your tax-free personal allowance. It creates this bonkers 60% effective tax rate on a slice of your income. It's a real trap, but a pension contribution can be your secret weapon here. By paying into your pension, you can lower your adjusted net income and potentially dodge that trap altogether. And it's not just about how you pay yourself from the company. There are other powerful moves you can make. Your £20,000 ISA allowance is a use-it-or-lose-it deal each year, and any dividends inside are totally tax-free. Pensions, as we've said, offer amazing tax relief, and here's a simple one that people often overlook. If your spouse pays a lower rate of tax, transferring some dividend-paying investments to them can be a really smart move.
But listen, it's really important to remember that tax planning isn't a one-and-done job for 2026. You need to look ahead, because these changes are just one piece of a much bigger puzzle. Just take a look at this timeline. The squeeze is well and truly on. First, we have the dividend tax rise in 2026. Then, from April 2027, there are big tax hikes planned for both savings and property income. You can see the pattern, right? It's a clear strategy to increase the amount of tax taken from asset-based income. Okay, we have covered a lot of ground. So where does that leave you? Let's pull it all together and talk about your next steps. So, if you remember just 4 things from this explainer, make it these. First, dividend tax is going up by 2% for most of us. Second, that fiscal drag from frozen allowances is going to make the hit feel even bigger. Third, the salary and dividend combo is still your best bet, but the advantage isn't as big as it used to be. And finally, using things like ISAs and pensions isn't just a nice-to-have anymore, it's absolutely essential. Okay, and now for the really important bit. Please remember, this is all general guidance. Tax is incredibly personal, and your situation is unique, so this is not a substitute for professional, tailored advice from an expert.
So, if you're thinking, right, I need to get my own plan sorted, then we're here to help. You can call us, email us, or visit our website. All the details are right there. And for more clear, no-nonsense tax guides just like this one, please make sure you subscribe to our YouTube channel.
So I'll just leave you with this one last thought. Now that you know exactly what's changing, is your financial plan really ready? Not just for 2026, but for 2027 and all the years after that.